Welcome to all of you. Paul, I'll start with you. What are your expectations, and how do you think the market setup looks?
I think Chair Powell is going to say the Fed's in a good place. There's lots of details about this whole thing, but the general conclusion is that the Fed's in a good place. They're restrictive, unambiguously restrictive. The labor market is moderating. The path towards a soft landing or a soft normalization is proceeding apace. I think the Fed's in a very good place. I think he will say that. I think, as Steve was noting, he will also note that if they're not in the perfect place, it will be because they need to move up a little bit more. But I don't think he's going to show any urgency whatsoever about getting off the good place and embrace the notion that the market is not fighting him anymore.
The market's doing some of his work.
Exactly. They've been fighting him for the last 18 months. We inverted the curve over a year ago, and the market not fighting the Fed makes the Fed's job easier.
He's not going to say we're done, but he might use code that says we're done. What would those code words be?
There's a line in the statement that we've had for the last 7, 8 months that he could change a little bit when effectively he says that, we'll be, as we evaluate the need to tighten some more, we'll be looking at this, this, and this. But, the presumption is the next move would be a tighten. So in the statement, he could effectively soften that presumption that the next move will still be in the up direction.
Words like sufficiently restrictive.
Oh, man, that's the big phrase. And I don't think they will say that in the statement. But dollars to donuts, he's going to get asked that at the press conference. Sir, are you sufficiently restrictive? And it's going to be interesting to see how he handles that question. But I doubt that they would say that. Yeah. Very much doubt they would say that.
Okay.
He certainly, Subhadra, has a track record, or the Fed does, of the market kind of taking the initial decision in stride, and then to Paul's point, seeing more of the sell-off or the risk-off move happen during the chair's comments at those press conferences.
Yeah, we don't really expect much of a change in this statement. I think you're probably going to hear Chair Powell talk about proceeding carefully from here on. But for the most part, I think following on the heels of the ECB as well as the Bank of Canada, the focus is going to be on delivering a hawkish pause and keeping their options open to hike more if needed. We've had very strong data thus far. Today's data, of course, was a little bit weak. Manufacturing has been on the weaker side. Employment remains relatively strong. And inflation is coming down ever so gradually towards perhaps 3% by the end of the year and 2.5% by the middle of next year. In that sort of context, I think it's a little too soon for the Fed to really guide the markets towards any sort of a pause, even though the rise in long-end yields is already doing the work for them.
Subhadra, let me just jump on that ISM manufacturing report, which wasn't supposed to be the scene stealer today, but it was really bad. It felt, it had been improving the last couple of months. We thought maybe it would go back into expansion territory above 50. Then it fell all the way back to 46. These kinds of readings are historically consistent with a recession, aren't they? I mean, shouldn't we be making more of this?
Yeah, absolutely. And I think that if you ask me, if you look at the data in aggregate, ISM manufacturing has been weak for a while now. So we've been in a manufacturing recession for quite some time now. It's a question of when this is going to spill over to the services side, and when the consumer, if anything, is going to be retrenching from the spending splurge that they've had during the summer months. And I think that that's going to come in the fourth quarter because the consumer is starting to come under an increasing amount of pressure. Student loan moratoriums expiring, as well as higher gas prices are all eating into disposable income. So I think the fourth quarter, you're going to start seeing the consumer start to pull back.
So, Nancy, notwithstanding those numbers on manufacturing, the economy has been remarkably resilient. So why has the economy been as resilient as it has been in the face of a Fed that has been very persistent in raising interest rates? Why hasn't it slowed more?
Yeah, Tyler. I mean, I think this is the first time in my career where we've had a Fed and fiscal policy at odds. You've got the federal government spending a tremendous amount of money, and the fiscal thrust continues. And so that's provided economic growth that may be the wrong way, but economic growth nonetheless. And then I would also argue that although the consumer may indeed pull back at the low end, what, in my experience over the last 4 decades, is that individuals spend, U.S. consumers spend out of net worth. We are at we are above pre-pandemic highs. So we're at 175 trillion in net worth. Half of that almost is the baby boomers at 77 trillion. So this is a cohort that, for the most part, doesn't have mortgages, and they have time, and they're spending. And I think that surprised a lot of investors.